Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Vonage's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Vonage is a business and consumer telecommunications provider. In its early years, it mainly focused on selling services to individuals like me and you. Through a series of acquisitions beginning in 2013, it expanded its presence in the business-to-business marketplace. Currently, 1/4 of its revenue is from consumers and 3/4 is from businesses. Last month, Ericsson announced it has reached an agreement to acquire Vonage for $6.2 billion in an all-cash deal. That's equivalent to $21 per share. That's a premium of 28% above the stock price when the deal was announced. Vonage will become a wholly owned subsidiary of Ericsson, but will continue to operate under its existing name. Ericsson is a massive Swedish telecom company. By acquiring Vonage, this will allow Ericsson to expand its presence in a wireless enterprise market that could grow to $700 billion by 2030. The transaction is expected to close in the first half of next year, pending regulatory and shareholder approval. As you can imagine, Ericsson is very excited to add Vonage's 120,000 customers. Also, it benefits from using Vonage Communications Platform because Vonage's platform makes it really easy for developers to embed messaging, voice, and video communications into their applications. Ericsson expects the deal to improve its adjusted earnings per share and free cash flow by 2024. The Swedish telecommunications giant stated its long-term goal of free cash flow as a percentage of revenue to be between 9% and 12%. This acquisition should help them reach that goal. The company is headquartered in Holmdel, New Jersey, and was founded in 2001. It trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a mid-cap company, $5 billion market cap. They're trading at $21 a share, and they have 253 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow, peaking in the trailing 12 months at $109 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's positive in 2018, negative after that. Revenue is the sales for the company, and that grows each year from $1 billion to $1.4 billion. This is the company's annual income statement since 2018. The top line is the revenue, the sales. Here's a breakdown of their 2020 revenue. $1.2 billion of revenue, $332 million in consumer, and $915 million in their business division. They can easily sell their services all over the world. They had $849 million of revenue in the US in 2020, $80 million in the UK, and $319 million outside of those two countries. They're pretty much a service business. They provide video service, cloud service, tech service. So that's where most of their revenue is. $1.1 billion from services, $37 million from products, and $63 million from USF. USF is a service to subsidize consumers and businesses in low-income areas. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Cost of labor is a big cost of revenue for this company. Revenue minus cost of revenue gives you your gross profit, and that peaked in the trailing 12 months at $712 million. Below that is our operating expenses, and below that is our operating income, which was negative in 2020. It was the most in 2018 at $52 million. It's currently $31 million. They pay $29 million of interest on their debt in the trailing 12 months, and the bottom line of the income statement is their net income, which is negative every year except in 2018. This is their most recent income statement. This is the third quarter of 2021 versus the third quarter of 2020. And the top line is the revenue, the sales. That was $358 million. That grew from $316 million in the same period in 2020. And they break out USF revenues from their other revenues. You can see in USF cost of revenue, it's the same as USF revenue. So it seems like for those low-income consumers and businesses, they're just breaking even. Their expenses were $161 million from their services and products business versus revenue of $342 million. They spent $87 million in marketing, $18 million in trying to come up with new products, $44 million in general and administrative expenses. This could include payroll, rent, insurance, and $23 million of depreciation and amortization. So they do have a lot of expenses, so they have a really small operating income of $9.4 million, but it was negative $10.6 million in the prior period last year. They paid $7 million of interest on their debt, so they do have negative net income in both quarters. Here's their annual statement of cash flow since 2018, and the top line is operating cash flow. That's how much cash the company generates from its operational business. Even though they reported a net loss, they're actually generating positive cash flow. This is because of all the non-cash items on the income statement, like depreciation, amortization, stock-based compensation. They spend about $50 million a year in CapEx. This is investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow, and they do have positive free cash flow every year, so that's a good sign. It looks like they're adding a similar amount of debt each year as they're paying down. And you can see in 2018, they had $96 million of free cash flow, yet they added $600 million of debt. They did pay down $300 million of debt, so overall they added about $280 million of debt. Why would they add so much debt if they have positive free cash flow? They had $26 million of CapEx, so they weren't investing a lot back into their business. But if you look at investing cash flow, that was negative $400 million. CapEx is part of investing cash flow. What was the other $380 million? Probably an acquisition. Generally, when a company has positive free cash flow and they add a lot of debt, it's usually to acquire another business. Here are the statement of cash flows for the first 9 months of 2021 versus the first 9 months of 2020. And this is their cash flow from operations section. And the way you calculate CFO, you start with net income or net loss, and then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. We have to add back the $33 million of depreciation. That's a non-cash expense that brings down your net income that we have to add back here on the statement of cash flows. $32 million of amortization. They had $15 million of amortization for deferred acquisition costs. Stock-based compensation is when you subsidize your employee's salary with stock. They had $48 million of stock-based compensation. They extended $28 million of credit to their customers, so that's a cash outflow of $28 million. When you buy something on credit, like if you go to the store and buy a TV with your credit card, that's similar to a cash inflow because you didn't spend any money. It's like taking a loan when you use your credit card. When you actually pay for the product, when you receive your credit card statement and pay for it, then it's a cash outflow. So they bought $59 million of product on credit, but in the future, they're going to have to pay for that. So it's a cash inflow in this reporting period. They had a cash outflow of $8 million for deferred revenue. Deferred revenue are payments received in advance for a product or service. For example, if one of their services is $10 a month, which will be $120 for the year, they offer an option that you pay $100 up front and you get the service for the entire year, saving you $20. So when a customer pays that $100, it's a cash inflow. But each month the customer uses that service, it's a cash outflow because they have to take part of that $100 off their balance sheet and put it onto the income statement as revenue. Even though they reported a loss of $2.3 million, they actually generated $133 million of cash flow. So they're not doing that bad. Sometimes in the early years, when you buy a lot of fixed assets, you pass through these large depreciation expenses, which brings down your net income, so it looks negative, it looks bad. But once you depreciate most of those assets, then in the later years, you will have a net profit because you're not passing through as many expenses. This top part here is the cash flow from investing section for the first 9 months of 2020 versus the first 9 months of 2021. They spent $7 million in CapEx. They acquired software assets for $35 million. So in their investing section for the first 9 months of 2021, they had a cash outflow of $42 million. In their financing section, they paid off $65 million of debt. It looks like they paid $22 million of taxes on employee stock, and they received $2.4 million from stock options. So they had a cash outflow of $84 million. Last year at the same time, they had a cash inflow of $13 million because they added $75 million of debt. This is the equity section of their balance sheet as of 9/30. They have $619 million of equity. They raised $1.6 billion from selling their business, and they lost $669 million from running their business. Accumulated deficit is a sum of all your prior net incomes. So they're probably cash flow positive because a lot of their net income is dragged down from depreciation, and they bought back $342 million of stock. Let's look at the capital structure. They have $619 million of equity, $496 million of debt. They're 56% equity, 44% debt. And I gave them the lowest whack on Finbox, 5.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.5 billion. We divide that by 253 million shares. And we get a calculated stock price of $14. They're trading at $21, so they're trading at a 48% premium. It's a sell according to the model. The average analyst projects their revenue to grow 13%. To calculate their future revenue, I grew at 13% for the next 4 years. And to calculate their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers. And that comes out to about 6%, so I multiplied their future revenue estimates by 6%. That's how I got their future free cash flows. Simply, Wall Street values the company at $8 a share. 12 analysts price this stock, and the average price target is $21. This is where the stock has been trading the last 5 years. It really crashed in March 2020 when the entire market crashed. It's come up a lot since then, and there's a big gap up right here. That's when Ericsson announced the acquisition. So the stock immediately went up to about $21 a share. But as you'll experience in life, an asset is only worth as much as someone's willing to pay. If you feel your car is worth $10,000, but nobody will pay you more than $5,000, then your car is not worth $10,000, even if you feel that way. Same thing with a stock. Even if I say a stock is worth $10, $15, $100, it doesn't really matter. It's what people are willing to pay. Ericsson is willing to pay $21, therefore the stock is worth $21. If the deal falls through, the stock price will come back down to probably where it was before. But right now, the floor is pretty much $21, and it's pretty likely the deal will go through. They have a pretty low beta, 0.62, so the stock moves less than the market. It's gone up 61% in the past 52 weeks, while the S&P is up 27%. The 52-week low was $11, the high was $21. And the stock is trading above its 50-day and 200-day moving average. There's been tons of buying activity since they announced the acquisition. Almost 15 million shares are traded each day. Of the 253 million shares outstanding, 238 million are on float. Almost all the shares are held by institutions, and 8% of the shares are shorted. Their total employees has been pretty steady the past couple of years. It's up a bit from 2015. They're currently at 2,200 employees. If you invested $10,000 into this company 10 years ago, you'd be really happy at $87,000 today. That's a 24% annual return. One insider bought shares the past year, and I'm sure they're really happy, 93,000 shares at $12 each. The biggest shareholder is BlackRock at 13%, then Vanguard, Janus, Park West, and Jana Partners. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is pretty good at 3.8. That's stock price over sales per share. That means investors are paying $3.80 for $1 revenue. Their price to book is 8.4, which is not so great. That's stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities, and they have $619 million of equity, negative $263 million of tangible equity, since they have $882 million of intangible assets on their balance sheet. A company gets intangibles on their balance sheet when they acquire another company. They have a low return on invested capital of only 2%. They can just cover their interest payments one time. They have a negative ROE since they have negative net income. And a lot of telecom companies have a low current ratio. They're 0.8. Their quick ratio is also 0.8. They have $48 million of cash on their latest balance sheet and $138 million of receivables. Receivables is the money that's owed to them by their customers. Even though they have negative working capital, negative $46 million, they bring in enough cash flow to cover that deficit. They had $109 million of free cash flow in the trailing 12 months. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 15 companies in the same industry as Vonage. And Vonage is doing a lot better in price to sales, a little better in price to book. They are lower than average in current ratio. They have a negative ROE, average is positive. They're a little lower in debt than the average company, and they're a pretty small company, $5 billion. The average is $62 billion. And most companies in this industry pay a dividend. They do not. So to summarize, I have them trading at a 48% premium, but the company is really worth $21 today. I'm just showing you the value of the company, excluding the acquisition. But I don't think there's much upside at this point. Also, I don't think there's much downside unless the acquisition falls through. But I believe once the acquisition does go through, this company will still be trading under ticker VG. It will just be a wholly owned subsidiary of Ericsson. Ericsson will consolidate all of Vonage's financials into their financials. But this seems like a good move for Ericsson, and their stock went down once they announced the acquisition. Generally, the stock price for the company that's doing the acquiring goes down because they have to use cash or take on debt to acquire that company. And the target company stock price goes up because the acquiring company pays a premium for the target company in almost all cases. I rank their free cash flow 7 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.